Hello, everyone. Hope everyone is doing well. All right, so today we want to talk about something different than taxes. If you're following me, if you're one of my clients, you know that for any clients I work with, for the business to thrive, we're focusing on three pillars. One is boosting the financial profitability. I want you to be profitable. I want you to be generating profit. Second is optimizing cash flow because profit doesn't mean cash in the bank. And third is the tax planning side is to reduce the tax liability. Yes, we're making good profits, we're making good income, we're having stable cash flow, but we also want to reduce the tax liability. So those are the three pillars that we focus on working with any client. And it breaks my heart for any client or any potential client that comes talk to me and he's a business owner but doesn't know anything about their finances. I usually ask questions about how did you do last year or how much income you have made so far. If something like we're in 2025, for the first 5 months of 2025, how much did you make so far, gross versus net? And most often I don't have I don't get answers or people do not know. And don't tell me that what you got in the bank is what you made because that's not the right answer. What you have in the bank does not equal your net profit or how much you've made of profit in your business. So as a business owner, you need to know how to read the financials, and that's what we focus our presentation today on. We spoke before about the three main reports that we look at: balance sheet, profit and loss, statement of cash flow. We went through the breakdown of what's included in each and what is the difference between each one of them. Let me know if you want me to go over that again, or if you want to be specific on one of these reports, or if you have questions about any of that. But today, I want to reveal to you the two reports that I always go for when I look at any business to see if it's healthy, to see if it's good, to see if it's triggering any flags. And I come from an auditor background. I started my career working for Deloitte. So as an auditor, we do all these kind of analysis, and it helps like knowing where you are and how to go from there. So what am I talking about? Let me share my presentation and my screen, and we go from there. So yes, we're talking about the balance sheet comparative report and the profit and loss comparative report. The balance sheet comparative report, we spoke about the balance sheet before, showing assets, liabilities, and equity. All of this is good. But what I'm focusing on today is to look at your comparison report, whether it's from a year to a year, whether it's from this month to last month. But usually when like the general one or the main one that I go to is a year to year. But if you're just starting, then we can do a month to month. If you're seasonal, we go for the period of time where your season is, and we compare. We have to compare because it tells us a lot of things about the business. We see where we are, where we were, and where we are now, and that helps us to see where we're heading. So something like that. Let's take a look. This is like a dental office, and they have a balance sheet and some current assets, fixed assets, and this is their total assets right there. When I look at, I want to see how much of a change is there from, let's say this is from last year to the year before. So last year looks like they were in overdraft, and maybe there were some checks written that were in transit or they were in overdraft situation. But now looks like they're in a better position. At least from that perspective of cash flow, they're in a better position. So just by looking at this one line item, it tells me where they are cash flow wise. We take a look, and one of the other things, without even comparing, is looking at when we look at the financial statements, is to see if there's something that doesn't make sense, like having a negative receivable or a negative fixed asset, unless it's accumulated depreciation, of course, or negative payables. Like down there, when we look at the payables, and if there is negative payables, then that tells me that there is something wrong with your bookkeeping. That tells me that because it shouldn't be. That's not the nature of the account. And if it is negative, that means something is wrong. You have missed something. There is something that's being recorded improperly and need to be fixed. You need to be cleaning up your finances. That's also another point that always comes up when we review the financial statements. And when I see something negative here, meaning it's not in its position. Most of the accounts, whether it's on the balance sheet or profit and loss, should be positive, except for a few, because their nature should be negative. Something like the accumulated depreciation, this has to be negative. So if this is positive, then it means it's done wrong. So here, by looking at this, what do you see? You see that there was here, when we compare the fixed asset, looks like they bought some new dental equipment. So just by looking at the report from the outside, I already know a lot about the business. I knew that they bought a new dental equipment. There looks like they're current on the accumulated depreciation. They recorded this. Accumulated amortization looks like this was already completed from before. I don't want to confuse you with the terms. What's the difference between this and that? My purpose is for me to take a look at the high level picture and see what can I learn about the business just looking at this, and what questions would I ask. So this is, as I said, this is just by looking at this, I learned that they bought some new equipment this year. Let's go, keep going. And of course, the chart of accounts are different from one business to another. So it will be totally different for your business than what it could look like here. But this is just a sample. For credit cards, look at this. I see that they had an Amex Gold card of 37,000. This year was 34. But what happened? I see other three new credit cards that were not there last year. So they opened three new credit cards. So that's another information that I got just by looking at the balance sheet comparative. And I can tell that they have increased their credit card debt from 37 to 77. So looks like we're having a little bit of an issue here with our income, or with our yeah, something is not like healthy right there, because there is a lot of credit, unless this credit was used for like higher, like doing more financing, doing, I mean, like more investing or something like that. Then I have to ask why there is a higher debt this year. And the loans from shareholders increased. So that's another thing. Looks like the shareholder had to put in a lot more money this year. So that does tell me that the business is not doing so well in 2024 compared to 2023. And we're going to be looking at the PL and see if that makes sense. But look, another thing here. There is an equipment finance of 24,000, and looks like this dental equipment that we said was bought in 2024, because it's similar amount. It's 25,000 that they bought, and looks like they bought it on debt. They bought it using an equipment finance or a loan. So that makes sense. They didn't have to pay for that by cash. They paid it by an auto finance. So that looks here good. The financials look healthy for me. Nothing is off its nature. So whatever it's positive, positive, negative, negative. Of course, when your retained earnings are in negative, that means you've been accumulating losses year after another. And look here, the last item, and we mentioned this on the financial how to read the financial statements video before. When this net income is negative, meaning there it's actually a net loss, and this number is coming from your PL. So if we take a look at the PL here, and I'm switching screens, it is $78,000 in losses. So let's see why there is a huge loss like that. And let's take a look. Yes, our income went down from 506 to 367. That's a decrease of 27%, about 140 almost in a decline. So that's something that you need to look at and see, oh, what happened? Why my income went down from 506 to 367? My cost of goods sold makes sense that it would also decrease if my revenue decreased. And again, this is one of the things when we analyze the financials, we look at if your cost of goods sold increased, even though your income decreased. So something doesn't make sense here. How? Unless you don't really like you're not categorizing the transactions properly, or something is off here that needs some explanation, because why the cost of the goods you sold would be less than the income you generated? Was it a cost that you bought from prior years, or what happened there? But it makes sense that it would decrease if the total income also decreases. But look here, another issue I'm seeing when reviewing these financials, that my advertising and promotion didn't go much down. It went from $40,000 to $38,000. So this is something that would stop me, and I would be talking to my client about. You spent almost the same amount of advertising and promotion, but your income went way down. So does that advertising strategy that you're using make sense? Do we need to make it changes there? Are you using the right people? Are you using the right ways or like strategies there? So by looking at this, it helps me to make the right decision. Do I need to continue here? You're not giving me the right results that I need. I'm spending too much in advertising, but I'm not getting what I'm expecting. All right. Something here like auto expense. Why is it too low? Something that I would be asking, are you not using your car for business? Like, why are you having such a little auto expense? It could be the situation. I'm not saying it doesn't have to be, but it's a question that we ask when we review the financials and we see, okay, something here is off. Business license and permits, when I see that it went up like three times last year, I have to ask, maybe something was miscategorized, or maybe it went up for some reason. Continuing education also went up. Oh, so this doctor went for continuing education, maybe business development, maybe something had to do with he felt that there is a problem with the business and he wanted to develop that. That's why he went for continuing education. Maybe, but it's worth asking. Computer and internet, it's about the same, not too much of a problem here. Depreciation, I don't know why there was no depreciation last year. Maybe this has something to do with the equipment that we bought this year, and last year there was nothing. Let's take another look at the balance sheet. The fixed assets, let's go up to the fixed assets. Yeah, my fixed assets were zero last year, meaning that all the assets I had were fully depreciated. So there was no depreciation expense last year. But this year, because of the new equipment, we had to record depreciation. And looks like this was done tax basis because that's a high amount. So maybe they took 80% bonus depreciation there. All right. Interest expense, it makes sense that it went up high. You know why? Remember? because of the credit card debt. So it looks like there is a increasing debit credit card debt, and we're not paying off the full amount when it's due. It's paid over time, and there are interest expenses that are like that's being paid on it. Insurance expense is about the same. Bank service charges, nothing that triggers question or problem here. Maybe office supplies, I would ask why it went down so much. Is it were we closing the office? Maybe that's why we didn't have to buy many supplies. There was less income. Maybe it's something to consider. Rent expenses went up a little, which makes sense with inflation. It would go up a little bit. Professional services went up. Maybe he had to hire somebody to do something. So that's another question to ask. All these are the same taxes, others. So I guess that's something that may have to do with business license and permits that were up there. So it looks like there is some miscategorization between here and there because of the difference between this year and last year between those two accounts are about the same. This went down and this went up about the same amount. So it looks like they're using these two accounts interchangeably. So that makes sense to me. Travel expense went up a little bit, or actually the double here, almost the double. So I have to ask whether it's actually fully a business. Maybe there are some personal travel included there, and we need to categorize it properly. So we have to ask. Um, but again, this tells you a lot of questions that you need to, okay, when you review this, if especially if you're using somebody to do your bookkeeping, they should be sitting down with you on like a quarterly basis, annual basis, whatever it is like you're engaging with them on to be able to read the finances. I'm not saying that you need to be totally independent and do this on your own, but I'm saying that you need to be aware of what's going on. You need to be able to read your finances and are able to understand what's going on and what goes onto your tax return. Why do you have to pay too much this year or pay less than last year? Um, let's continue here. I see. Okay, so it looks like they had a profit sharing contribution last year that's not included this year. Maybe they terminated the plan. Maybe they still need to record this. We need to ask. Salaries, they cut staff. Look here. It was like 50% less than last year. So they cut staff about 50%. So again, maybe they were closing the office. Maybe they didn't see enough patients coming in. So they had to lay off some employees. That tells me a lot about the business already before even having a conversation. That tells me what to ask for and what do I need to know about the business. So as a business owner, all of this is very, very important for you to know what's going on. So even though your bank account, let's go back to the balance sheet. At the end of the year, your bank account had almost $9,000 in it. But that doesn't mean that you had $9,000 profit. You actually had a loss of $78,000. So again, do not rely on what's in your bank account because part of this, you funded some of these losses from your own pocket. That's why we had a loan from shareholder. So that's just to explain it. And loan from shareholder is not income. That's why it is recorded on your balance sheet, and that absorbs part of the losses. So again, this is what you need to be looking at to understand where you are. And from there, you will take decisions, same as we said, with about advertising and promotion, with about salary and staff. Do we need to hire more people? What comes before the other? Do I need to incorporate more expenses? What tax strategies that I'm missing here? Am I missing a home office? Am I missing bonus depreciation on my car? Am I missing Augusta rule? Am I working from home or not? A lot of things here that can be explored just by looking at the financials. There are already a lot of potential for tax savings and for boosting our profitability if we are like if we're aware of what's going on. All right. I hope that you found this to be helpful. If you have any questions, if you need to review your finances and see where you are, I'm here to always help. All right. See you later. See you next week. Bye.